Chatting with the management of UPL, they've posted a weak set of Q4 numbers. Top line below estimates. Net profits have seen a decline of 43%. This is on account of a sharp correction in the company's margins. EBITDA margins at 18.2% has fallen by nearly 450 basis points on a year-on-year basis. Mike Frank, CEO of Global Crop Protection Business at UPL, is with us on the show now. Mike, first, could you talk about this margin decline that we've seen? How have crop prices trended in the quarter gone by in Q4? Is it on account of excess supply that we're seeing from China? And what's the outlook on margins in Q4? In Q1, I'm sorry.
Hi, yes, good to be with you. So if you just step back and look at the full year picture, we delivered very healthy 16% revenue growth and 10% EBITDA growth. Obviously, the first 9 months we saw strong EBITDA growth along with revenue growth. And in the fourth quarter, it was a very unusual quarter. As you said, coming out of COVID in China, what we saw is the post-patent manufacturers of active ingredients in China really increase their overall productivity and supply into the market. And as they did that, prices started to decline. And as prices started to decline, it really froze distributors from buying products when they saw the price was moving quickly. And so as the quarter played out, we saw that prices came down almost on a daily basis in the last part of the quarter to where they are now. We took very aggressive actions. Firstly, we made sure we competed for shelf space and we got our products on the shelf of our distributors, and so we competed aggressively. And we also really managed our inventories to make sure that we liquidated our high-cost inventories and we slowed down our production plans so that we wouldn't end the year with more inventory or more high-priced inventory. So generally, we're very pleased with how we performed in this very challenging quarter. And in particular, the post-patent segment was the segment that got impacted the most.
All right. Hi, Mike. Good afternoon. We take that point on board. So the high-cost inventory, most of it is out of the system, which should spell good news in the coming quarters. Give us a couple of details in terms of a guidance. For the last year, you achieved more than what you set out in terms of revenues. Though on the EBITDA front, it was lagging a little bit. So I want three broad numbers for you. One, what is the revenue guidance from year on growth, the EBITDA guidance, and net debt reduction? Please go ahead, Mike.
Yeah, so last year on overall guidance, we achieved and beated our net revenue guidance. We underperformed on EBITDA, again, really based on the fourth quarter, and we're very pleased with the cash generation that we had in the business. And so we were able to pay down over $600 million of gross debt, over $440 million of net debt here at the end of the year based on that strong cash generation. Now, as we look ahead to FY24, at guidance, we're guiding on revenue of 6 to 10%, on EBITDA of 8 to 12%. And again, we're expecting a very healthy cash generation from the business. Now, this year, unlike last year, we're not going to make a guidance on paying down net debt. We're quite happy with the current leverage that we have. But as we generate excess cash in the business, we'll make decisions as the year unfolds in terms of the best way to put that cash to work.
Mike, hi, good afternoon. So as compared to FY23, the guidance that you're putting out, and these are consolidated numbers, right? 6 to 10% revenue and 8 to 12% EBITDA growth. This is muted in that sense, right? As compared to what you've done in FY23. So is this on the back of the crop business continuing to be under pressure? I mean, if one looks broadly at weather forecasts, etc., as well, I mean, they're not very good. Could you explain?
Yeah, so firstly, let me take the last part first. From a weather perspective, obviously we have a very global business. Last year we had weather impacts in Argentina, largely in southern US and in parts of Europe. And so every year we do see some impacts from weather. As we go into this next year, this part of the world could be a little bit wetter, but generally we expect actually a benefit on a year-over-year basis from a weather impact standpoint. Also, if you look at grower margins are still very healthy. So we would expect farmers around the world to want to maximize productivity and also maximize their sustainability outcomes. And that's where UPL plays such an important role with both our conventional crop protection business, but also with our differentiated and sustainable solutions. we're in the midst of transitioning our portfolio from being dominated with post-patent products, which in FY23 was about 72% of our sales, to when we look ahead to FY27, we believe our portfolio will be roughly split 50-50 between post-patent products and differentiated and sustainable solutions. So we do expect, as FY24 starts, that some of those challenges with post-patent prices that we are seeing in the market today, those will persist at least in the first quarter or two. But again, our objective is to run our factories to compete very aggressively in that segment, to gain market share and move increased volumes, and then to grow our overall differentiated and sustainable solutions throughout FY24.
Mike, you're saying pricing pressure in post-patent products will continue in the first half of FY24? That's your estimate?
Yeah, we would anticipate that. We're seeing it already in our first quarter, that we would anticipate for at least the first quarter and probably the first half that these new competitive pressures will continue to play out. Look, it's hard to predict over time the price of post-patent products that are going to come out of China. What I'm telling you is that we have a very good cost position based on our manufacturing capabilities here in India, and we will run our plants, we'll compete aggressively, and we'll grow our volumes in that segment, regardless of what the price is going to be.
All right, Mike, there's some uncertainty out there, but besides the operational performance, there were some news reports that indicated that maybe the UPL promoters, they could look at exiting the business. And these sort of rumors keep coming up. Now, you work closely with Mr. Schropp, and I was hoping that he joined on the show, but he hasn't. What's your sense on it? I mean, is there any discussion of any sort? Is UPL on the block?
No, I would say there's no discussion, and I think if you look closely, you'll see that the promoters are continuing to increase their ownership in the company. And so, yeah, working very closely with Jay and his family, they're very committed to the business. They're very committed to growing the business, and so I would say those rumors are simply just that.
Right, so you're clarifying that the company is not on the block. That's good news. But as you said, the promoter entity, they have gradually been hiking stake. Now, in the last year or so, if I look at it, they have hiked stake by nearly around 5%. Do they have a targeted holding out there? It's around 32.3% as of March 2023. What does Mr. Schroff have to say? Does he want to take it? Does he have a target in mind? Because, valuation-wise as well, it's not been getting those elevated multiples. So maybe if the promoter shows more amount of faith, takes his holding higher, the street gets more excited and gives it a higher value. Your take, do you have any number out there?
Yeah, look, if you look at the fundamentals of our business, we have an incredible business. We generate significant free cash flow. I think when you look against our peers, our multiples are much lower than our peers, and so I think there's a lot of opportunity for multiple expansion, and we've got a great growth story in the years ahead. I think you'd have to ask Jay himself in terms of his objective, in terms of what percent of ownership they would like to have, but I can tell you our business is extremely strong, and we're going to continue to drive growth in this business and generate free cash flow.
All right, Mike, thanks so much for giving us an insight into business, how you see things panning out. You're clarifying as well that as per what you understand, the company is definitely not on the block, and please do convey to Mr. Schroff, we would like to know where exactly does he want to take this holding. He's been creeping into the shareholding, so maybe we get an update from him next time around. Look forward to chatting up with you in the coming weeks and wishing you a good FY24. Well, let's